Hello. The Tax Cuts and Jobs Act of 2017 was enacted on December 22nd, 2017. Now, one of the provisions in the actual act, we've never seen anything like it before in the entire history of the Internal Revenue Code and the tax law, and that is the Qualified Business Income Deduction under Section 199 Cap A. Now, this provision provides a benefit to pass-through entities, potentially to the owners of those entities. And by pass-through, what I'm talking about is entities that are taxed at one level, not like a C corporation where you have double taxation. So we're talking about sole proprietorships, S corporations, partnerships, and LLCs, those kind of entities. And we look at the actual owner. Now, this could potentially give a benefit of 20% deduction, which is huge. So huge that it packs a punch. Hope you like that. Well, we're going to go actually into the provision, and it's very much like a maze. This provision is very, very difficult, very complex. I really hope that this video helps you understand what the provision is all about, how the rules are applied, and some examples to give you some insight on what exactly to do with the provision. We're going to talk about the mechanics of the Qualified Business Income Deduction. Specifically, we're going to focus on the introduction, the history, the mechanics, 6 situations which are really the heart of this video, because understanding these 6 situations is really the key to understanding the mechanics and the basics of the Qualified Business Income Deduction, as well as other considerations. Now, I want to mention that this video is not meant to be an advanced discussion of the Qualified Business Income Deduction. It's meant to be a very basic discussion, just so you get a brief understanding, and then you can go into the specifics, do some research and look at the specifics for your client or for your tax issue or for whatnot. It's really meant to just focus on, again, the basics. I have another video that deals with planning issues, and even the planning issues video, again, is meant to be a basic discussion, not really meant to be an advanced discussion. So let's start with the introduction. Before we talk about the introduction of this deduction, I want to mention some acronyms and terms, because throughout the presentation, as well as you'll see that many practitioners, they'll throw out various acronyms. Some use different acronyms than others, but so you need to have a general understanding of the acronyms with respect to this provision. I've tried to keep my acronyms very similar to what's used elsewhere in the tax world. So when you see QBI, we're talking about Qualified Business Income. QBID, or QBI deduction, is the Qualified Business Income Deduction. So this provision that we're talking about. CQBI is the Combined Qualified Business Income. QTB is Qualified Trader Business. SSTB is Specified Service Trader Business. TI is Taxable Income. MFJ is Married Filing Joint. And OTH is Other for Other Filing Status. Now, many of these provisions are actually in the Internal Revenue Code, Section 199 Cap A, which is the Qualified Business Income Deduction provision. So these terms aren't just made up, they're actually put into the legislation through Congress of what the provision actually entails. Very important to understand. Now, throughout this discussion, I try to keep, or at least at first, introduce, when I first talk about a term, use it in the full sense, and then talk about the acronyms. But if you ever get lost, come back to this point in the video and look at this slide to look at, okay, what does that acronym mean again? So you can go back to it. So this is towards the beginning of the video. Just remember that. If somebody came up to you in an elevator and asked you, what exactly is this Qualified Business Income Deduction? What is the QBI deduction? I heard about it, once the tax law came out, Tax Cuts and Jobs Act of 2017, there was this new deduction, 20%. Wow, 20% deduction, that's huge. What is this? Do I get it? Who gets it? Who doesn't get it? Do I get it? You'll get all sorts of questions like that. If you're really trying to keep the definition simple, and it's really hard to do that in tax, as we know, because usually, you get a whole mouthful, many paragraphs of what you have to do to define an actual term or an actual provision from the tax law. And that's the same with the Qualified Business Income Deduction. It really is a very long definition, very winded definition of what it is. But if I had to simplify it, and you have to make sure you're very conditional on how you say this, I would say if you own and operate a trader business, you may, keyword here is may, be able to deduct 20% of the taxable income from that business. So we key in on own and operate, trade or business, 20% taxable income from that business. And again, very much highlight you may. And the reason why may is so important is because there's various limitations, there's several various limitations on the deduction. You have to calculate the deduction for each trade or business and then do a combination, which you'll see how this works, and that's why it's mechanical. And additional amounts may be added. We'll talk about those more in detail, but we're talking about REIT dividends, real estate investment trust dividends, and publicly traded partnership income. A portion of that might go into this. Even though we're talking about qualified business income, those might actually be added in there as well. So again, if you're in that elevator, you tell them, and then the taxpayer or the client says, or potential client or just a friend or whoever it is, they might say, okay, I know what a deduction is, but what I have to ask you is, what kind of deduction is it? Is it like an itemized deduction? Because I take the standard deduction. Well, your response should be the location of the QBI deduction, or what it is, it's a below-the-line deduction. It's a below-the-line deduction on the tax return. So it's on page 2 of the tax return, but it's actually calculated after the standard or itemized deduction, the greater of those two. It's actually calculated after. So on page 1, we have gross income minus above-the-line deductions, which gives us adjusted gross income. That's on page 1 of the 1040. Page 2, we then subtract away our below-the-line deductions, which are from AGI. So above the line is also known as for AGI, and then below the line is known as from AGI because you're taking it from AGI, adjusted gross income. So we first take the greater of the standard deduction or itemized deductions. Then we also take out personal exemptions, which might be 0 depending on the year you're watching this. And then we calculate our taxable income, a subtotal taxable income. From that, we subtract away QBI deduction, which is what this provision is. So it's actually calculated and subtracted away below the line, but after the standard deduction or itemized deduction. It's a separate item there. Very important to understand. So really the key is that if someone does take the standard deduction because they don't have enough itemized deductions, this can still be taken in addition to the standard deduction, if that's the case. But it is a below the line deduction, not above the line deduction. So it's somewhere in between being, as we know, above the line deductions are the best, they're better than below the line, but it's still better than being a true Schedule A itemized deduction because you don't have to fight with the standard deduction rule, the greater of standard deduction or itemized deduction rule. So the next thing we need to talk about is, this is the qualified business income deduction. What is qualified business income? So it's really income from a qualified trade or business, including sales income, production income, and service income. Now, many of you might be thinking, well, that's a very broad definition. And it is. It's very much in the sense of, okay, you look at, it has to be from a qualified trade or business, which we're going to talk about more of that later on. It has to be from a trade or business is key. And it's really what we think of when we think of business income, the plain vanilla, sales income, production income, service income. Now, more specifically, QBI is a net amount. It's not like, okay, when you learn gross income and tax purposes, gross income is a gross concept. This is actually a net amount. And it takes into account each owner's allocable share of each qualified item of income, gain, deduction, and loss. And it's important to note that trusts and estates, through ownership in these various business entities, as we mentioned earlier, you own and operate, can actually get the deduction as well. It's not just limited to individuals. It can actually be taken by a trust or estate. A better way to look at what is and what's not qualified business income, or what is qualified business income, is to look at what is not qualified business income. And it really is a lot of the passive types of income out there. Now, some passive income that relates to the business that this provision deals with are allowed. So no dividends can be put into qualified business income, right? Because remember, we have to know what qualified business income is because we're going to be able to take 20% of that and get a deduction. So dividends are not QBI, qualified business income. Interest income, generally speaking, is not QBI unless the interest income is allocable to a trade or business that is at issue. So for example, interest from selling inventory on credit. So you borrowed some money to buy inventory and then you're paying off that interest. That can be, because that's viewed as related to that business income, it's directly related to that, that's viewed as interest income paid to deal with the inventory. Annuity income is generally not in QBI unless, again, it's in connection with the trade or business. Capital gains and losses from investments, those are never QBI. Reasonable compensation, this is huge. Please pay attention. Reasonable compensation received by the taxpayer is not considered QBI. So this is wages or contract income if you're an independent contractor, not QBI. Guaranteed payments and Section 707A payments received by the taxpayer from, if it's a partnership or LLC, not QBI as well. Very important. So that goes along the lines of the compensation. As many of you know, partners cannot receive wages, but they can receive what's known as a guaranteed payment. So in that respect, guaranteed payments are not QBI as well. Now, to be considered QBI, you must be domestic activity, effectively connected with the conduct of a trade or business within the United States. So this goes into the international versus domestic issue. The idea here is we have this provision. It does provide some benefit, and maybe potentially, we're going to talk about the history in a few moments, but some people might say that this could be a policy sense in the sense that we want to promote investment and operations in the U.S. Now, here is probably one of the most important slides. And before we actually dive into the mechanics, it's important to understand how exactly is the QBI deduction or the QBID calculated. The QBI deduction is calculated as the lesser of the combined qualified business income, which we're going to talk about what that is next, of the taxpayer. And by the way, it's going to be 20%. You're going to see it's 20% of something. Don't worry. You're probably wondering, where's the 20%? It's going to be there. You'll see. It's on the next slide. Or 20% of the taxpayer's taxable income minus net capital gain. So basically, there's a taxable income limitation on this. There's actually two taxable income limitations. You see here, one of them is 20% of taxpayers' taxable income minus net capital gain, but it can never, the QBI deduction can never be greater than 100% of taxable income. And by the way, when we say taxable income, again, I said this earlier, we mean, or if I didn't say it earlier, I'm going to say it again in the future many times. When I talk about taxable income for this provision, we're talking about taxable income before we take out the QBI deduction. So again, the QBI deduction is the lesser of combined qualified business income or 20% of a taxable income limitation. So let's talk about what is combined qualified business income, or CQBI, or simply combined QBI. So combined QBI is the sum of all deductible amounts for each trade or business, which that's really going to be the heart of the mechanics we're going to dive into in a few moments, plus 20% of all qualified REIT dividends and plus 20% of qualified publicly traded partnership income. Again, as I mentioned earlier, there is a 20% item aspect, and that also is in that all deductible amounts for each trade or business. That also is going to have a 20% element you'll see later on. But before we get into that, I want to mention the taxable income limitation. So I mentioned earlier, taxable income is before the QBI deduction taken into account. Very important. And again, there are two taxable income limitations with respect to this deduction: the 20% of taxable income minus net capital gain, and also 100% of overall taxable income. Again, those are before we subtract away the QBI deduction. So let's just take a simple example. And I know we haven't gotten to the specific mechanics yet of how we calculate combined qualified business income, but just bear with me. A taxpayer has combined qualified business income of $100,000. Taxable income is $200,000 with 20,000 of net capital gain income. Now that combined qualified business income of $100,000, that already has taken into account 20% of the qualified business income, which we'll talk about later, just so you know. So again, as we saw in the slide, the qualified business income deduction that the taxpayer can take is the lesser of the combined qualified business income amount, so the CQBI, or 20% of the taxable income minus net capital gains. So it's take taxable income minus net capital gains and multiply that by 20%. And again, there's an overall limitation of 100% of taxable income. And this taxable income here is before we take out the qualified business income deduction. So it's the lesser of the combined qualified business income of the taxpayer, which is $100,000, or 20% of the taxpayer's taxable income, which is $200,000, minus net capital gain. So $200,000 minus $20,000 for that taxable income limit is $180,000. $180,000 times 20% is $36,000. So we take the lesser of $100,000 or $36,000, and the qualified business income deduction, Section 199 Cap A deduction for the tax return, which is taken on page 2 of the 1040, is $36,000. So that's how the limitation works. History. So we talked about the introduction of the provision and how it actually goes on the tax return and what exactly it is. Again, we're going to dive into more details later on. But I want to take a little segue into history. So this provision came from the Tax Cuts and Jobs Act of 2017, signed into law on December 22nd, 2017, and did not apply until January 1st of 2018. Now, the Qualified Business Income Deduction came from the Senate version of the Tax Cuts and Jobs Act of 2017. So, just a little brief history of what happened in 2017. We had big push for tax reform, especially during the summer of 2017. This was something talked about for many years. And it was said, okay, well, we need to do some things about the international tax law. The corporate tax rate needed to be lowered. It was 35%. We need to drop that to be more competitive with OECD countries, or internationally, we need to be more competitive. So those are the big things that drove the tax laws, especially the corporate tax rate. Corporate tax rate was dropped to 21% as of that tax law. But before I go into that provision, or what actually happened, we have the House bill, which comes out in November of 2017. And in the House version of the bill, it's a completely different approach than we saw with the Senate bill. There was a 25% rate cap on the pass-through income with various limitations. So when we talk about pass-throughs, what we're talking about is entities that have one level of taxation that get passed through to the actual owner. So sole proprietorships, partnerships, LLCs, S corporations, single-member LLCs. These are all pass-through entities. Okay? So there's going to be a 25% rate cap on pass-through income with various limitations. And the rules, they adopted definitions from activities from passive losses under Section 469. Okay? And there were bright line rules dealing with wages and qualified business income, which we're going to talk about later on. Much more articulate and much more bright line than what we have under the Senate bill, which is what we're going to be talking about, the provision we actually have of the qualified business income deduction. Now, I want to mention again that corporate tax rate of 21%. That's what actually came into play. So we knew, or the bills all lower the corporate tax to around 20. There was actually talk of lowering the corporate tax rate to 15%. But they knew that there was going to have to be some negotiation, and it was going to be more closer to between 20 and 25%, because the OECD rate was around 21 to 22% average, looking at the OECD countries. So it was more realistic to get about that amount. Now, with the corporate tax rates being lowered, and with the individual tax rates still higher than that, even with the tax bill, looking before and after the tax bill, there were many out there that were concerned about going back in time. See, prior to the Tax Reform Act of 1986, we had individual tax rates in the 1970s and 1980s, highest tax rate 70 to 80%. Very high, ordinary income tax rate. But the highest corporate tax rate was between 45 and 50%. So what a lot of individuals were doing to get around the very high ordinary income tax rate is they would conduct business through a closely held C corporation and retain the money in the closely held C corporation. So instead of being taxed at 75%, 80% ordinary tax rate on each dollar, the highest rate, they'd be taxed at, let's say, 45 to 50%. So you can almost cut your taxes in half by putting it through a C corporation. And again, it was a closely held, which means that there was either one or just a few owners. And very closely connected to the owner was the employee, and they were the owner a lot of times was the employee as well. So in fear that would happen again, by lowering the corporate tax rate again, because we want to be more of an international player, looking at the international markets, the fear was that that's what would happen again, is that the closely held C corporation would become a tax planning tool again. Rather than have that become an issue, Congress, the Joint Committee on Taxation, Senate Finance Committee, Treasury, they all knew we had to do something to get some type of benefit to lower the burden of the issue on pass-through income, pass-through taxation. The idea is that if you aren't familiar with these pass-throughs, sole proprietorships, partnerships, LLCs, S corporations, you're allocated income loss deduction. It passes through at the ordinary or capital or Section 1231 rates. It passes through to the owner as if the owner was taxed on the income. So those ordinary tax rates, close to 40%, before and after the tax bill of 2017, you'd be taxed at 40% rather than pay, if you're a corporation, pay potentially 20 to 25%. So the idea was, okay, let's do something for these businesses, these pass-through businesses, so that we can lower the burden on them as well. So again, we don't have this issue. Everyone flocks to the C corporations for tax planning purposes. The House bill proposed, again, a 25% rate cap. The problem is that the small business group did not really like that. Because if you look at our ordinary income tax rate structure, it's a progressive structure. And small business owners, let's say that you only make $50,000, but you own a small business. You have $50,000 in income, sole proprietorship. You have a very small business. And you're doing a business, let's say you're an ice cream vendor. You have a small business, ice cream vendor. You have $50,000 in income for the year. If you were to be taxed on that $50,000 under the ordinary income rates, you would not be at the highest ordinary income rate. You'd be much lower than that. You might be hit with 10 to 15% tax rates. So if we have a 25% rate cap on pass-through income, how would that benefit this small business owner that only makes $50,000? Well, that's exactly what the small business lobby, that's the issue they threw out there. So the Republicans, as part of this tax bill, they knew that they had to, as one of the biggest constituents of their lobby, the small business lobby, they had to make them happy. So rather than propose a rate cap, where again, only the upper middle class to the upper class taxpayers, in terms of income, upper class of income taxpayers would get the benefit, rather than have that, they just said, let's just put a deduction in place. So that's what the Senate bill did. It put a deduction, 20% of qualified business income, but there's going to be certain limitations based on wages and other things, okay? So we have this provision. Now note that the House bill did use Section 469 in the passive loss rules. The Senate bill did not use Section 469 and the Senate bill. The passive loss rules. Senate bill does not even reference anywhere, not even in legislative history. There's not supposed to be any reference, at least when the bill was passed. And again, I mentioned the bright line rules of the House bill. The Senate bill takes a more subjective approach to that, a more gray area, facts and circumstances, when we look at those things later on. Now, we had the House bill come out in early November 2017. Senate bill followed later on in 2017. Because of the reconciliation process, in order for the Republicans to have a tax bill actually pass, the Senate bill is what dominated. So that's why we got the provision that we did from the Senate bill, because the Senate bill is what dominated due to reconciliation. If you don't know what reconciliation is, I've mentioned budget reconciliation. I would like you to stop the video and go take a look online on what budget reconciliation is, because it's very important, because that's how the Tax Cuts and Jobs Act of 2017 got through. So that's really the history. And then the Senate bill really is the one that came back into the House, the Senate, got passed, got signed into law, December 22nd, 2017. Boom, that's what we got. Now, a few things I want to mention is that the Section 199 Cap A, which is the provision in the Internal Revenue Code where the Qualified Business Income Deduction actually is located. It's Section 199 Cap A. It's got many similarities and references to other provisions, but there's two ones that are particularly important. It's important because one of them deals with the structure of the current, of Section 199 Cap A when it was enacted, and the other, Section 1202, is used in a reference for a very important exception we're going to talk about. So Section 199, Domestic Production Activity Deduction, was actually repealed from the Tax Cuts and Jobs Act, but Section 199 Cap A, the Qualified Business Income Deduction, took a very similar format, mainly with respect to the wage limitations we're going to talk about later. Also, a lot of the way it was structured, the actual provision. Section 1202, Exclusion of Gain from Small Business Stock. This is a provision that deals with C corporations and is a way that C corporation owners, if you qualify and you're a small business, again, lots of provisions in the code that benefit small businesses. If you're considered a small business and you have a C corporation, to avoid double taxation or to lessen double taxation, you potentially can exclude gain on the sale of the stock when you sell stock, or partially exclude. That's what Section 1202 does. Section 1202 is important because certain businesses do not count for Section 1202, and those are going to be used as a reference for the Qualified Business Income Deduction, which are going to provide an exception to the Qualified Business Income Deduction, which we'll see later on. It's known as the Specified Service Trade or Business Rules. So let's go into the mechanics. That's the legislative history. That's going to help us in our understanding. Very important, just so you know. Mechanics. So this is really what you came for, to understand how exactly it's going to work, or how exactly the Qualified Business Income Deduction works. And this is really what we're focusing on. So I've created this decision chart. Very important. I definitely recommend stopping and looking at this. This is very important decision chart. It helps you understand. So, and we're going to go through these items, just looking at each aspect, and we're going to talk about each thing because it shows you how exactly to navigate this provision. So one thing I want to note is you see the top title, the QBI deduction, the deductible amount for each trade or business. As I mentioned earlier, you got to go through each trade or business when you're doing this determination. Now again, as I mentioned, we're going to go through each of these all the way from own and operate a trade or business at the top, down to the last item, which says to calculate the combined QBI amount. The actual deduction is 1 and number 2 added together. So we will look at those together, or we'll look at all of these things. And again, it is a decision tree. It's like a flow chart. It goes in order. You got to go down the path. We'll see how things work. You'll see lots of stopping points. You'll see lots of limitations. We got to go through these things. Another thing I want to mention is, as many of you are probably aware, to calculate the Qualified Business Income Deduction, many services like Lineberg and even various accounting firms have their own calculator. Yes, having a calculator is helpful, but it really does help you understand the planning aspects by learning the compliance and how the calculation is actually done. So when you watch the planning video later on, this is truly going to help you understand how things work. And I'm trying to simplify this as best as I can by breaking it into various ways. So the first thing is we look at, do we have an owner and an operator of a trade or business? You have to own and operate a trade or business. Because if you don't, you can't get the Qualified Business Income Deduction. So that really makes us think, well, what do we mean by trade or business? Looking at trade or business, we have a whole line of jurisprudence under Code Section 162, dealing with general trade or business deductions. And one of the big Supreme Court cases, again, looking at a whole line of Supreme Court jurisprudence, is Commissioner versus Grotzinger, 1987 Supreme Court case, which says that in defining trade or business, we accept the fact that to be engaged in a trade or business, the taxpayer must be involved in the activity with continuity and regularity. and that the taxpayer's primary purpose for engaging in the activity must be for income or profit. A sporadic activity, a hobby, or amusement diversion does not qualify. So I've really highlighted two things there. Must be for income or profit is obvious. It has to be gain-seeking or profit-seeking activity. Okay? Well, that, if you remember back to your basic income tax class, if you look at the various categories of activities with respect to deductions and income, there's what I call the big three. And these are the order that you want to be in. First, we have business. If you're not business, then the next one you might want to be, or you would want to be, is investment activity. And then finally, we have personal activity. So gain-seeking or profit-seeking, that's the first two, business or investment. You would always want to be business over investment because business has less limitations and more ability to take deductions. So the key distinction, so if business and income are must be for income or profit, what distinguishes something as business versus investment? And that's really where the continuity and regularity comes into play. So if you are doing something continuously and regularly, that is viewed as your trade or business, versus an investment can be viewed something as maybe on the side, where it's not done as often, or you're not directly or regularly involved. So that's how we determine trade or business with respect to the QBI deduction. Next thing is, if you own and operate a trade or business, you can, and you're not a C corporation, you're going to continue. If you're a C corporation, you can never, I repeat, never get the QBI deduction. Why do you ask? We just talked about it earlier, the history. So now it's all making sense. Why did we go on that little detour of history? Take a second, pause, think about it. Remember, C corporations, that's what drove the Tax Cuts and Jobs Act of 2017, which, by the way, is the first time that we saw a provision like the Qualified Business Income Deduction. Never before in the over 100-year history of the U.S. income tax have we seen a provision like the Qualified Business Income Deduction. First time from the Tax Cuts and Jobs Act of 2017, this is the new thing, comes into play. So the C corporations were driving the provisions. It's important to note that if the C corporations have a lower tax rate, which after the tax bill was enacted, C corporations have a flat tax rate, or had a flat tax rate of 21%. And again, the Qualified Business Income Deduction was put into play so that people were not driven to change all their businesses to C corporations and conduct through C corporations for the lower tax rate. It would make no sense whatsoever for a C corporation to get the benefit of the Qualified Business Income Deduction. Do you see that? Very important distinction, or very important to understand. So C corporations can never qualify for the QBI deduction. However, all other business entities can, and again, the key words that we focus on is flow-through entities. Entities that are pass-throughs or flow-through, where the allocated items of income, deduction, loss, credit of the business, they flow through or pass through to the owners. And again, examples of those sole proprietorships, partnerships, LLCs, S corporations, those are the big ones. Very important. So C corporations cannot get this provision. So again, we start at the top. We own and operate a trade or business. We're not a C corporation. So now we come to a fork in the road, where we have three possible paths. We're either going to be viewed as a specified service trade or business, a qualified trade or business, or the trade or business of being an employee. Now, we're going to talk more about what these mean and the specific application, but I want to go ahead and I want to give you the summary here. We all know what traffic lights. We know what they are. We know the colors: green, yellow, red. Red obviously means stop. Yellow means caution. Green means go. And that's what I've used here as well. You'll see that green is a qualified trade or business. This is the best category to be in. Being a qualified trade or business, you're going to see has the least amount of limitations in terms of getting the deduction. So remember earlier we started in the elevator telling our hypothetical taxpayer what this provision is all about, and we had to make sure that we were specific to say you may get the deduction because there's lots of limitations. The qualified trader business category has the least amount of limitations. It's green, it's go. The next least amount of limitations, the specified service trader business category. It's possible to get the deduction under a specified service trader business, but it's severely limited, and there's also times when you can't get it at all. So that's a caution, a yellow. Finally, red means stop. Trader business of being an employee. If you are in the trader business of being an employee, you can never get the QBI deduction. Never. It's stop. You do not go. You're at a red light. You stop. You can't take the deduction. So really, it comes down to the specified service trader business, which has extreme caution, and the qualified trader business, which is you got the green light, you got the go light. Very important. All right? So really, we have to talk about the distinction because many of you are saying, well, I don't want to be a trader business of being an employee. Definitely don't want to be that. And if I'm between the qualified trader business or specified service trader business, I want to be the qualified trader business. And you're exactly right. So we got to talk about these things. And in my planning video, I talk about this even further because a lot of planning deals with activity planning and deals with these kinds of issues. So what is a qualified trader business? The green light, the go light. Well, Section 199 Cap A, the Qualified Business Income Deduction provision, says that a qualified trader business includes every trader business except for. So basically says that you are a qualified trader business unless you are a specified service trader business or you're in the trader business of being an employee. Remember, specified service trader business, also known as SSTB from our acronyms, is the yellow light, the caution, and the trader business of being an employee is the red light, stop, you can't get it. Very important. So what is a specified service trader business? And we're going to talk a lot about this in the planning video, so make sure you look at the planning video. Very interesting topic in planning video. So a specified service trader business is defined using Section 1202, E3 Cap A, as well as one other paragraph, which is number 2. So number 1 and number 3 that you see here come from 1202 E3 Cap A, with the exception that engineering and architecture are specifically excluded from being an SSTB. Why, you might ask? Very interesting. Very interesting indeed. Engineering and architecture. That's something that you might want to look into. Again, this is meant to be a basic discussion, so you might want to look into why exactly was engineering and architecture left out. I think perhaps maybe it's because engineering and architecture a lot of times have components of both services and sometimes goods. You could be a sales engineer, you could deal with goods and services, potentially. Architecture might get into the lines of construction at some point, where construction is going to be a qualified trader business, which is our green light. So engineering and architecture always have the green light because they're specifically taken out. However, look at number 3. Any trader business where the principal asset of such trader business is the reputation or skill of one or more of its employees. Well, wouldn't engineering and architecture also fit in that? If you have an engineer and architecture, isn't that the principal asset is a reputation or skill of what they do? That's a great question. Again, that's something for you to look into. I'm going to go ahead and say that this is going to be a narrowly tailored definition. So, and engineering and architecture still have that strong arm language, as I call it. So that's very important. So items number 1 and items number 3, again with the carve out of engineering and architecture, come from Section 1202, which is the small business stock rules we talked about earlier. 1202 E3 Cap A. Okay? And again, with 1202 E3 Cap A, that's number 1, number 3 here. Number 1 being service providers in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, and brokerage services. What about banking? Would banking fit in financial services? Think about it for a moment. For the answer to that, tune into the planning videos. Number 3 is any trader business where the principal asset of such trader business is a reputation or skill of one or more of its employees. Very broad language. That encompasses, by that definition or by that wording, almost everything in the service or that has, you can even say with goods as well. But again, as I mentioned, this is something for you to look into, and I would say that you probably should look at a more narrow definition. So number 1 and number 3 come from Section 1202E3 Cap A, specifically referenced in this provision. Number 2 is added though. Any trade or business which involves the performance of services that consist of investing and investment management, trading or dealing in securities, partnership interests, or commodities. So it can be any of these, 1, 2, or 3. Okay, now number 2 again is added beyond the Section 1202E3 Cap A stuff. So that is a specified service trade or business. And again, if you are one of these, you have the yellow light, which means caution because you are going to be severely limited, as we'll see in the 6 situations later on. So let's talk about being in the trade or business of being an employee. So what exactly are we talking about when we mean the trade or business of being an employee? Well, before the Tax Cuts and Jobs Act of 2017, lots of provisions were out there allowing for certain deductions and benefits if you're an employee and you're in the trade or business of being an employee, but you're doing some other type of activity. The idea here is that, and there was all sorts of like regs and provisions, and they're still out there, but again, the Tax Cuts and Jobs Act 2017, it limited at that time those items. So if you go through those regs, you'll see what trade or business of being an employee is. But really, if your main business is being an employee of a business, but you're performing some other type of activity, well then it's viewed as you're in the trade or business of being an employee with respect to your primary activity, which is the employer-employee relationship. So this is kind of a esoteric, but the idea here is if you are, this is where it can get a little dicey. You're wondering, how can you own or operate a business? Let's say that you are the employee of an accounting firm, and then you decide, rather than be an employee of the accounting firm, why don't you leave the accounting firm, start your own business, but then work exclusively for that accounting firm. You do 100% of your work at your firm is for the accounting firm. Well, you, under the tax law, could still be viewed as being in the trade or business of being an employee because, yes, even though now you're owner of a business, you still work exclusively for that business. So under the 162 regs and case law, we see this issue as well, where this comes up, as well as potentially under 269 Cap A, which deals with a special anti-abuse rule for being in trade or business of being an employee and putting a cap on stuff. So that's, if you're in the trade or business of being an employee, you can't get the deduction. You stop. You can't do it. Okay, that's the idea. And we'll talk more, you'll learn more about that in the planning aspects with respect to various items. All right, so continuing, we are talking about mechanics here. Now, before we go into our yellow light and green light situations, yellow light being the SSTB, Specified Service Trade or Business, and the green light, the Qualified Trade or Business, we have to talk about the wage and property limitations and the role of them. Because you're going to see it's going to play a role with respect to those two types of trade or business. So the role of the wage and property limitations, the QBI deduction is the lesser of 20% of QBI or the wage and property limits. Right? So remember, we learned earlier that the QBI deduction on the tax return is the lesser of the combined qualified business income, right? And the taxable income limitations. And then combined qualified business income is the QBI deduction for each trade or business plus 20% of REIT dividends plus 20% of publicly traded partnership income. The QBI deduction for each trade or business is the lesser of 20% of QBI with respect to that business or the wage and property limitations. So what are the wage and property limitations? The wage and property limitations is the greater of 50% of the W-2 wages or 25% of the W-2 wages plus 2.5% of unadjusted basis immediately after the acquisition of all qualified property. So we'll go back to the previous slide. Again, the QBI deduction, which goes into what you can actually take on the tax return, is the lesser of 20% of QBI or wage and property limits. but the wage and property limits is the greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of the basis of qualified property. So the idea here is, again, if you look back, your QBI deduction could be 0 if the wage and property limits apply and you have 0 for the wage and property limitations. Because 20% of QBI is going to be a number, or the wage and property limits, if they're 0, they're 0. And if, let's say the QBI is positive, we'll talk about what happens negative and the other considerations later on. But if the QBI is a positive number, greater than 0, 20% of that is going to be lesser than 0, which is wage and property limits. So your QBI deduction will be 0. And if you don't have any REIT dividends or publicly traded partnership income, your QBI deduction, your tax return is going to be 0. So the wage and property limitations are huge. They potentially could make you get 0 deduction, even though you have QBI. And what you might be thinking here is, what if you are a sole proprietor and you operate a service business, you lease your building and all your equipment, and you have no employees? You're an LLC, let's say, or again, sole proprietor, and you don't have any wages. You don't pay any wages. No wages at all. Just you, the owner. Well, if the wage and property limitations apply, what's going to happen? Your wage and property limits are going to be 0, and your QBI deduction is going to be 0 because it's the lesser of. And then if you don't have any REIT dividends or publicly traded partnership income that qualify, you don't get anything with respect to this. But if you did pay some wages, or you had some property that you could use in the calculation, you could maximize your QBI and actually get the deduction. So now some of you are probably wondering, this is very interesting. And the planning video talks a lot about that. So when you finish this, go over the planning video, because you'll learn more about how do we maximize that. But before you go to the planning video, keep with me here. I know this is really long. I know this provision is one of the longest provisions in the Internal Revenue Code. It's really important you understand how this works, because to understand the planning, you have to understand how the provision works. So that's the wage and property limits. So again, it's the greater of 50% of W-2 wages or 25% W-2 wages plus 2.5% of the unadjusted basis of all qualified property. So now we have to talk about what's W-2 wages and then what's this qualified property unadjusted basis issue. So W-2 wages are determined based upon the amounts shown on a W-2 that is properly and timely filed with the Social Security Administration on or before the 60th day for filing the return. So as W-2s are due on January 31st for most years, the deadline is April 1st in terms of doing the 60 days. Okay? So what are not W-2 wages? Guaranteed payments are not W-2 wages. Distributions from S corporations or partnerships are not considered, or withdrawals if you're an owner of a sole proprietorship. Those are not W-2 wages. If they're not filed in the Social Security Administration within 60 days. This is a compliance trap, and it's important to make sure that you timely file and retain proof of filing. And then any wages of a trade or business which do not relate to QBI. Now, it's important to understand that if the wage and property limitations do not apply, you'll see they don't apply in certain situations. Then you don't have to worry about, again, specifically the compliance trap, because the wage and property limits won't be an issue. But if they are an issue, you do have to worry about it, so this is very important. Now let's talk about qualified property, because again, remember, it's the greater of 50% of W-2 wages or 25% of W-2 wages plus 2.5% of qualified property unadjusted basis. That's what we look at. So qualified property is property subject to depreciation held by and available for use in a qualified trade or business at the close of the tax year. So we're talking about tangible, so it can't be intangible because that's amortization. Tangible, personal, or real property that is depreciable. So it can't be land or items that are not depreciable. And they're available for use in the qualified trade or business at the close of the tax year. That's very important. So as long as it's available for use and used at any point in the year in the production of the specific QBI. Has to be in the production of that specific QBI that we're doing the analysis for. Remember, we do this for each business. Have to place it in service by that time. Have to place it in service by that time. And it could be any day of the year. So if you're a calendar year taxpayer, January 1st to December 31st, as long as you place the property in service December 31st, and it's placed in service with respect to that production of that specific QBI, it counts. And the depreciable period is not closed at the close of the taxable year. The depreciable period, some of you might be wondering, well, is that the same as makers and what we use for other tax depreciation? The answer is no, it's not the same. It's actually better. Section 199 Cap A, the Qualified Business Income Deduction, actually has its own definition of the depreciable period. It's the later of 10 years after the date of property was placed in service, or the end of the expiration period under Section 168, whichever is later. So what we're talking about here is there's a lot of tangible personal property, like furniture, equipment, that's 5 or 7 years. Well, the later period is going to be 10 years. So you actually get 10 years with respect to that item. But what if you have real property that's 27 and a half or 39 years? Well, it's the later, so 27 and a half or 39 years are greater or later than 10 years, so you use 27 and a half or 39 for the real property, or for anything that has more than 10 years. So let's take a simple example with office furniture. So office furniture was placed in service January 1st, 2015. The 7-year life, it would remain qualified property for 10 years, so all the way until December 31st, 2024. That's 10 years, even though the deduction may be claimed after 2022. I'm sorry, even though no depreciation may be claimed after 2022. So the idea is that this office furniture, which is very likely 7-year life property, over 8 years, depreciated over 8 years, still can qualify for the wage and property limits even beyond that in 2023, 2024 as well, even though it's not being depreciated after after 2022. Okay, so here we are. We're at the 6 situations. This is the heart of the mechanics. This is really where you're going to finally understand how exactly this works. This is where the value added comes to play. This is where the rubber meets the road. This is extremely important. This is also going to help you with respect to the planning video, so make sure you watch through this. So what we're going to do is we're going to look at 6 situations. We're going to focus on, remember when we came to that point in the road, that fork? Remember? Think back. If you have to go back in your video, go back. We own and operate a trade or business, and we're not a C corporation. After that, we have a fork in the road. Remember the red light, yellow light, and the green light. Red light says you can't take the deduction if you are in the trade or business of being an employee. No deduction. We had to stop. Yellow light is a specified service trade or business, SSTB. And the green light, which is the one you want to be in if you can get it, that's the go-ahead, is the qualified trade or business. Remember, the yellow light for specified service trade or business is caution, which means you might be able to get it, but it's very much limited. So we're dealing with 6 situations. And here they are. So this is going down that, if you go back many slides where we saw that big flowchart decision tree, we're continuing down. So we just got through the, we're going below the fork. We already looked at the trade or business of being an employee. It's a stop sign. You can't do it. Can't take the deduction. So now we're going below for the specified service trade or business and the qualified trade or business. We're going down. So there's 6 situations that you can be in if you are a specified service trade or business or a qualified trade or business. If you're a specified service trade or business, you're either in situation 1, situation 2, or situation number 3. If you're a qualified trade or business, you're in situation number 4, situation number 5, situation number 6. We're going to go through these, and we're going to go through using examples. Now, again, as I mentioned, you want to be a qualified trade or business. That's the best of the 3 categories. Specified service trade or business is the second best, and then, of course, as we know, being in the trade or business of being an employee is not good because you can't take the deduction. It was a stop sign. There's no possibility to get it. So what it comes down to is taxable income. what is the taxable income of the taxpayer? And it's distinguished between married filing joint and other filing statuses. Single, head of household, if you're a estate or trust. There's a threshold. So let's look at specified service trader business first. And it works the same with the qualified trader business. There's a threshold amount. In 2018, which is the first year, the threshold amount is $315,000 of taxable income. This is taxable income. For other taxpayers, so like single, $157,500. Now these are inflation adjusted. $315,000 and $157,500, which are half of one another, right? That was the initial amount. In 2018, they're inflation adjusted for years going forward. That's what we call the threshold. If you're below the threshold, those numbers, you're in situation number 1. There's also the threshold plus, which is the threshold plus $100,000 for married filing joint and $50,000 for the other amount, the $157,500. Again, half, $100,000, $50,000. And that $100,000, $50,000 adjustment, that's in 2018. These numbers, when you're watching this in the future, will be different, but the concepts will be the same. So if you're below the threshold of $315,000 or $157,500, depending on your filing status, you're in situation number 1. If you're above threshold plus, if you're at or above threshold plus, okay, which is, again, the threshold plus $100,000 for married filing joint, which is $415,000, or threshold plus for other is $157,500 plus $50,000, which is $207,500. If you're at or above, you're in situation number 3. If you're in between the two numbers and you're a specified service trader business, you are in situation number 2. It operates the same way for qualified trader business. If you're below the threshold, you're in situation number 4. I should say at or below. Sorry. Same with specified service trader business. If you're at or below the threshold for specified service trader business, you're at situation number 1. If you're at or below the threshold for qualified trader business, you're situation number 4. If you're at or above threshold plus for specified service trader business, you're in situation number 3. If you're at or above the threshold plus for qualified trader business, you're in situation 6. If you're in between these thresholds for specified service trader business, you're in situation number 2. If you're in between these thresholds for qualified trader business, you are in situation number 5. Okay? Very important to understand. And again, wherever you see an asterisk is an inflation adjusted number. So make sure you keep that in mind. So let's go ahead and start with situation number 1, 2, and 3 on the specified service trader business. And let's say we are at or below the threshold number, which is situation number 1. So we're at or below the threshold, and this is looking at taxable income. So one thing that's going to confuse students taking the CPA exam, tax professionals, is that the thresholds are taxable income. Again, remember before we take into account the QBI deduction, but the QBI calculation is on qualified business income. Those numbers are likely to be different for taxpayers. They're likely to be different. They could be the same, but they're likely to be different. Very important to understand. Okay? Very important to understand. So, if we're in situation number 1, we deduct 20% of the taxpayer's qualified business income net amount. There are no limitations. You simply just take 20% of the taxpayer's qualified business income. You take that number, you add to it 20% of the REIT dividends, plus 20% of the publicly traded partnership income. That gives you your combined qualified business income, right? And then remember, the qualified business income deduction is the lesser of the combined qualified business income amount, which is calculated, and the taxable income limitations. And boom, you're done. So situation number 1 is the best situation for a specified service trader business because there's no limitations on it. So here's an example. Single taxpayer. Single taxpayer. So we're looking at our other threshold. Has taxable income of $155,000. So we're below the other because the other threshold in 2018, at the time this video is filmed, again, it could be different in the future, is $157,500. So $155,000 taxable income is less than $157,500, so we're in situation number 1. Now $140,000 of that taxable income is QBI. So again, going back, since we're in situation number 1, we take 20% of the taxpayer's QBI. So we take 20% of 140,000, not 20% of 155. Okay, so here you see the application. So right here, we take 20% of 140,000, the QBI, qualified business income, which equals 28,000. So again, we take the 28,000, then we go to the next step, which we look at, we add REIT dividends, 20% REIT dividends, 20% publicly traded partnership income. We get that number. Let's say we don't have that. We have $28,000 because we don't have any REIT dividends or publicly traded partnership income. Then we do the lesser of 20% of taxable income minus net capital gain, or the 100% taxable income limitation, right? Or this number, 28,000. And because taxable income here is 155, right, situation 1 facts, and let's say we have no net capital gains, we don't have to worry about taxable income limitation. So boom, the QBI deduction on the tax return is going to be $28,000. That's actually what goes on Form 1040, page 2. Qualified business income deduction, $28,000. See how that works? That's how we do it. So let's go to situation number 2. Situation number 2. So situation number 2, we're between the threshold and threshold plus numbers. We're between the numbers. Okay? If we're between the numbers, we take 20% of the taxpayer's qualified business income times the applicable percentage. And we are subject to the wage and property limits, but they're phased in. Now let me explain. This seems complicated. This is complicated. Situation 2 is the most complicated of all 6 situations. Let me explain why. So, when you look at the situation 1, 2, and 3 for a specified service trader business, remember that situation 1, we are at or below the threshold. Situation 3, we're at or above the threshold plus. If you are in situation number 3 and you're a specified service trader business, you cannot get the deduction. If you're in situation number 1, you can get the deduction and there's no limitations. So that's huge. You're in situation 3, you don't get any QBI deduction, none. Again, you can get it with the REIT dividends and the publicly traded partnership income, subject to the taxable income limitations, all that good stuff. But if you don't have that, you don't get any QBI deduction. Very important to understand. Okay? So situation 2 is in between what happens when a taxpayer in situation 1 gets it with no limitation, and a taxpayer in situation number 3 doesn't get it at all. And this is a perfect example. This is not a new concept. Many of you know about credits and other deductions that are phased out. Basically, situation 2 is, the first part is a phase out. We deduct 20% of the taxpayer's qualified business income times the applicable percentage. We basically are going to do a phase out calculation because the closer you get to the threshold plus amount, right? In 2018, $415,000 if you're married filing joint, $207,500 if you're single. The closer we get to that, in between those situation 1 and situation 3, the more likely we should be phased out. So we're going to phase out as we go closer to the amount, because if we get to $415,000 or $207,500, depending on your filing status, it should be 100% phased out. So the closer we get should be phased out. And that's what you're going to see we're going to do. We're going to do it in steps. Now, another thing is that the wage and property limits in situation 2, they apply. But they apply in a phased-in portion because we are in between. Okay? And this has to do with what you see in situation number 6 for a qualified trader business, which we'll talk about later. And to give you a summary, if you're a qualified trader business, your situation 6, which is greater, you're above the threshold plus, again, $415,000 for married filing joint, $207,500 for other filing statuses. You get 20% QBI deduction, but you have to worry about 100% of the wage and property limits. The full wage and property limits are in play. So situation 2 takes into account phasing out as we get closer to situation 3, but it also takes into account the wage and property limits because we are getting to the numbers that, with respect to the higher numbers, like we see in situation 6 for a qualified trader business, the threshold plus numbers. All right. So let's look at a fact pattern. So we have a single taxpayer has taxable income of $177,500 and $140,000 of QBI. Now, the single taxpayer has W-2 wages of $50,000, allocable share. That's the single taxpayer's allocable share. And that single taxpayer is allocated $24,000 of unadjusted basis of qualified property. So, first thing to note, this is always where you should start, is, okay, well, if we've gone through, we own and operate a trader business, we're not a C corporation. Okay, we have that. That's good. Okay. But we know we're a specified service trader business. So now we have to determine, are we situation 1, 2, or 3? The next thing you should do is look at, okay, what's the taxable income of the taxpayer? Again, before the QBI deduction. That's $177,500, which for a single taxpayer is between the threshold and the threshold plus. $157,500 on the threshold number and $207,500 for the threshold plus. We're in between. So we're situation number 2. So again, we have to phase out the actual 20% QBI deduction, and we have to phase in the wage and property limits as you get closer. That's how it works. We phase out and phase in. Now, the QBI is 140, so that's going to be the 20% number of that. And then again, it's going to be limited by our phase out and phase in rules. And then we also have to worry about the wage and property limits, which are $50,000 W-2 wages and $24,000, which we have to calculate. So the way we calculate this, and this is again showing you that I just did it, situation 2 applies. If the wage and property limitations times the specified service trader business applicable percentage, which we're going to calculate, is greater than 20% of QBI times the specified service trader business applicable percentage, the QBI deduction is 20% of QBI times the specified service trader business. Okay? So here, in our case, if we look at the W-2 wages and the amount of the unadjusted basis of qualified property, if you remember the wage and property limits, which I'm going to show you on a slide how to do it, if you forgot, but the wage and property limits are the greater of W-2 wages, 50% of W-2 wages, so 50% of $50,000 is $25,000, or 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property. Well, if you calculate that, the 50% of W-2 wages is greater. So the wage and property limit amount is $25,000. So what we're saying here is, if the wage and property limitations times SSTB percentage is greater than 20% of QBI times SSTB percentage, then we just simply take the QBI deduction of 20% of QBI times the SSTB percentage. But if the wage and property limits are less than the SSTB times applicable percentage, then we have to take the QBI deduction, which is 20% of the QBI times SSTB applicable percentage minus the amount disallowed by the phase-in rule from the wage and property limits. So here, take a second and think. What are we? Well, remember, our QBI amount is $140,000. It's 140. Okay, if you look back at our facts, we're at 140,000. And again, the wage and property limit amounts is 25,000. 50,000 W-2 times 50%, which is the greater of, right? Which gave us 25,000. So what's greater? 25,000 or 140,000? Obviously 140,000, because the specified service trader business percentage is the same for both. It's going to be the same. So the wage and property limits is 25,000 times SSTB percentage is lesser than the 20% of QBI, which is 140,000 times 20%, which is 28,000. I apologize. I said earlier, what's greater, 140,000 or 25,000? It's going to be 28,000 versus 25,000. 20% of QBI is 140,000 times 20%, which is 28,000. 20% times 140,000 is 28,000. So that means that we're in the second case, so we use the below item. Okay? Now, if you're in the below item, you got to apply an 8-step process. An 8-step process. It's only 6 steps, though, if it's the first case where the wage and property limits are greater. And they're pretty much the same steps, except you just cut out 2 of those. So the first step is we determine the specified service trade or business applicable per percentage. Okay? And by the way, these steps are going to go through determining this issue right here. So don't worry, I know I did that already for you in my head, or I said it out loud, just to give you an idea of how you can think about this. But really, you can do this in the 8 steps. You do this in the 8 steps, and that's how I recommend learning it. So step 1, we start by determining the SSTB, the specified service trade or business, applicable per percentage. This is the excess of the taxable income minus the threshold amount. Okay? So really, what I mean by excess of taxable income is the taxable income number. Okay? Over the plus amount, which, if it's married filing joint, is $100,000. Okay? Or $50,000 for other. Sorry, I read that wrong. You know, doing this video is really long, right? What I'm saying by excess of taxable income minus threshold amount is I'm saying the difference of the following. Taxable income minus threshold. So really the formula is taxable income minus threshold amount. Okay? And again, the plus amount is what you add from the threshold to threshold plus, which is $100,000 for married filing joint, $50,000 for other. Well, we're single here, so we use $50,000. So remember, the taxable income here is $177,500. The threshold amount, looking back at our situation 1, 2, and 3, is $157,500. Again, that's in 2018. If you're watching this in the future, it could be inflation adjusted. We divide that by $50,000 for other. Again, that could be inflation adjusted as well for in the future. Depends. You got to look into that. So we get $20,000 or $50,000, which is 40%. So basically, the idea is that you're 40% into the phase-out rule. Okay? So the closer we get to $207,500, which is a threshold plus for a single taxpayer, that's where it's 100%. So we're in between. We are 40% in between that threshold and threshold plus. We're 20,000 over 50,000 because the range is 50,000. That in between is 50,000. We're 20,000 in. 20,000 over 50,000 is 40%. So we're 40% into phasing out. So we get 40%. Step 2, we calculate the wage and property limits, which we take 50% of W-2 wages, which is 50,000, which gives us 25,000, or we take 25% of W-2 wages plus 2.5% of the unadjusted basis of qualified property, which is 24,000. So we take the greater of the two. So the first number is 25,000. The second number is 10,600. So the greater of those two numbers is 25,000. Step 3, we adjust the wage and property limitation by the applicable percentage. So we take 25,000, which we just computed, times the specified service trade or business, which is 40%. Step 4, we calculate 20% of QBI times step 1, which is the SSTB applicable percentage. So we take 20% of QBI times 140,000, which is $28,000. We multiply that by the applicable SSTB percentage, which is 40%, right? We calculate that step 1. That gives us 11,200. So again, if we were at the threshold amount, 157,500, we'd be able to take 28,000 of the deduction. If we're at the 207,500, we can take 0 because we're in situation 3. But since we're in the middle, we're going to be somewhere in between that amount. We're going to be able to take 11,200 potentially, okay? Based on other, but we also have to do some other limitations. We have to phase in the wage and property limits. Step 5, we compare the 20% of QBI times the SSTB applicable percentage, which is step 4, and the adjusted wage and property limits of step 3. So really what we're doing is we're doing this. We're determining, is the wage and property limits greater or lesser? That's what we're determining. So we're looking at step 4 versus step 3. That's step 5. So which one's greater, 11,200 or 10,000? 11,200 is greater. So that means that that's from step 4, which is the QBI. So since we're using the QBI and not the wage and property limit, right? We're using the second, the lesser, the wage and property was lesser. That means we have to do more, which means we have the 8-step process rather than the 6-step process. Okay? If we were in the greater situation, the next step would be we take the QBI deduction and it's simply just going to be $11,200. Okay? We just take that number from step 4. That would be step 6. If we were in the greater, but we're not in the greater, okay? We are in the lesser, so we have to continue. So since the adjusted wage and property limitation, step 3 is lesser than step 4, then the QBI deduction is going to be that slide we just looked at from previous, which is 20% of QBI times the SSTB applicable percentage minus the amount disallowed by the phase-in rule through the wage and property limits. So step 6 is we calculate the excess of step 4 and step 3. So step 4, remember, is the QBI times the applicable service percentage, right? Minus the wage and property limits times the applicable service percentage, right? That gives us 1,200. Step 7 is we calculate the amount disallowed by the phase-in rule, which is basically we're phasing in the wage and property limits. So we take the reduction ratio, which is 1 minus 40%, the step 1 applicable percentage. So that's 60%. It's basically the percentage to get you to 100% of the applicable service percentage. So it's always 1 minus that percentage. And we multiply that by step 6, which was the $1,200 we just calculated. So 1,200, which is the excess amount in step 6, times 60% is 720. Finally, step 8, we take step 4, which is 11,200 QBI, minus step 7, the 720, which is the wage and property limits phased in, which gives us $10,480. And that is the amount of the QBI deduction. We take that QBI deduction, we do our 20% REIT dividends, plus 20% of publicly traded partnership income, if we have that. And then it's going to be the lesser of the combined qualified business income amount, that amount, and the taxable income limitations. So that amount goes on the tax return. So that's how it works. So situation 3, situation 2 is long, right? That's the longest one. But once you do situation 2, the rest of the situations, the computation is not near as difficult. So we can go a little bit faster. So situation 3, I already talked about this. You're a specified service trader business, and you're at or greater than the threshold plus amount, which again, 2018 is 415 if you're married filing joint, or 207,500 if you're single. Again, it's inflation adjusted for the future, so make sure you focus on that for the future. You can't take the deduction. Can't take it at all. Can't take it. So here's an example. So single taxpayer has $270,000 taxable income and $440,000 of QBI. By the way, did you notice in situation 1, 2, and 3 we had the same QBI? What changed was the taxable income. It gives us different results. Notice that, right? Because again, QBI is not what determines situations, taxable income. So we are in situation 3 because we're above 207,500. Again, this is based on 2018 numbers. Therefore, no QBI deduction is allowed. So that is a specified service trader business. Just to recap, situation 1, you're at or below the threshold amount. You get to take 20% of QBI. Situation number 3, the opposite end of the spectrum, you're at or above the threshold plus amount, no QBI. This is for specified service trader business. If you're in the middle, you got to do either a 6-step or 8-step process that we went through. Basically, what it's doing is, in a summary, in a nutshell, is, again, since situation 3, you're not allowed to take anything, you're phasing out the deduction, just like we do phase outs of credits and other deductions in tax. And then you're phasing in the wage and property limits because you're going to see situation 6 is going to have full wage and property limit phase-ins. So now let's talk about qualified trader business, our green light, because this is the best one to be in. And the reason it's the best one to be in is because situation 5 and situation 6 are not near as limited. So the first one is situation number 4, which we're at or below our threshold numbers, again, which are inflation adjusted. So here's a little situation. Husband and wife, they file a joint return on which they report taxable income of $310,000, of which $300,000 is QBI, attributable to W's trade or business, and an engineering, which is a qualified trade or business. Okay. So because $310,000 taxable income is less than $315,000, again for 2018, applying 2018 rules, and it's going to be less than anything in the future because it's going to go up. Then situation 4 applies, and we take 20% of the QBI. QBI was $300,000, so 20% times $300,000 is $60,000, and there's no limitations. We take the $60,000, we go through the REIT dividends, the publicly traded partnership income, and finally we go out of that, and then we take the lesser of the $60,000 if there's no REITs and publicly traded partnership income, and the taxable income limitations. Note that this is the same result as situation number 1. So whether you are a specified service trader business or a qualified trader business, if you're at or below the threshold taxable income number, it's the same result. So really there's no distinction here for a specified service trader business. And if you go back to the history, and again how this provision was supposed to help small businesses, that makes sense when again the small business was a huge lobby. Big deal. Small business was a huge lobby. That's why again, when you look at the House bill, 25% rate was the highest rate that'd be taxed. And again, the small business said, no, that doesn't give us benefits, because if you have the $50,000 business income taxpayer, well, they're only going to be taxed at 10 to 15% on that using the progressive structure for ordinary income. Well, doesn't give any benefit, but this does. So situation 1, situation 4, same result, helps out the small taxpayers. What about situation 5? Well, let me explain what situation 6 is. So situation 6, you're a qualified trader business, and you are at or above the threshold plus numbers, which remember in 2018, and this is inflation adjusted in the future, 2018, if you're married filing joint, it's $415,000. If you're other, so if you're single or any other filing status, it's $207,500. If you are a qualified trader business and you are at or above those numbers, you'd be in situation number 6. It'd be 20% QBI deduction, but it'd be limited by the wage and property limits, 100% wage and property limits. So that's a lot better than being in situation 3. Contrast that with situation 3 where you couldn't take it at all. So that's really important to understand. Now, situation 5, you do the 20% QBI deduction, but we phase in the wage and property limits that we have 100% at situation 6. So the closer that you get to situation 6, those numbers, that threshold plus number, that's when you 100% phase in the wage and property limitation. So you're phasing them in slowly over time. So the closer you get to that, the higher the wage and property limits become. That's the idea. So let's go through an example. So we're at taxable income of $355,000, okay, which is in between the threshold and threshold plus, and we have QBI of $300,000. They have wages paid $100,000. It's an engineering business, so it's a qualified trader business, and there's no qualified property. So since we're between in 2018 the 315 and the 415 for a married filing joint, we are in situation 5, which means that we get 20% QBI, but we have to, but the wage and property limits do apply, but they're phased in. Now here's something important. If the wage and property limitations is greater than 20% of QBI, the QBI deduction is simply just 20% of QBI. But if the wage and property limitations is lesser than 20% of QBI, then QBI deduction is 20% of QBI minus the partially phased in wage and property limitation amount. So you do subtract it away. Okay, that's how it works. The idea here is if the wage and property limits is greater, then you're going to pick the lesser number. Remember, the lesser of QBI deduction, which is 20% of QBI, or the wage and property limits. Right? You pick the lesser of those wage and property limits or the QBI. If the wage and property limits is greater, you wouldn't worry about it anyway. But if the wage and property limits is lesser, then guess what? It does affect the calculation, so you subtract away the partially phased in amount to adjust. You adjust it. So first thing we need to do here is calculate the wage and property limits. Well, the wage and property limits are going to be, well, we're told that it's $100,000 of W-2 wages paid that are attributable to W, right, in the engineering business, but there's no qualified property. So simply we take 50% of W-2 wages, which is $50,000. The second calculation is just 25% of W-2 wages, which is $100,000, so $25,000, and there's no qualified property, so that's $25,000. So we pick the greater of those two, which is $50,000. Okay? Then we take 20% of the QBI, which is 20% of 300,000 QBI is 60,000. So if we go back and we look at this slide that says if the wage and property limits is greater than 20% of QBI, then it's simply the QBI deduction, which is 20% of QBI. But if it's lesser, the wage and property limits is lesser, then guess what? We have to subtract away the partially phased-in amount. So looking at that, the wage and property limit here is $50,000. The QBI amount is $60,000. So since the wage and property limits is less, we are in the second category. So we have to do the QBI deduction, which is 20% of QBI, minus the partially phased-in amount. If it was greater, it'd be easy. Just be QBI, 300,000, times 20%, which is 60,000. You'd be done. That's all you'd have to do. But because it's lesser, we have to continue with our steps. Okay? So since the wage and property limits, 50,000, is less than 20% of QBI, 60,000, it's going to be the QBI deduction of 60,000 minus the partially phased-in wage and property limits. So to partially phase in the wage and property limits, we first have to calculate the partially phased-in ratio, which is similar to the applicable percentage that we calculated in situation number 2. We take taxable income minus the threshold amount, which is $355,000 taxable income, minus $315,000. That gives us $40,000. We divide that by the plus amount, which is $100,000 if you're married, filing joint, or $50,000 for other taxpayers. Again, this could be inflation adjusted in the future, which is $100,000 here because married, filing joint. So 40,000 over 100,000 is 40%. So this is the partially phased-in ratio, 40%. Next, step 2, so that's step 1. Step 2, we calculate the difference of QBI and the wage property limits. So we already did this, right? Or at least we already calculated 20% of QBI and the wage and property limits. 20% of QBI, we did this earlier, was $60,000. Wage and property limits is $50,000. The difference is $10,000. Step 3, we take steps 1 and step 2, multiply steps 1 and step 2. Step 1 being the phase-in percentage, step 2 being the difference. So 40% times 10,000 difference is $4,000. So that is, step 3 is the amount, the amount that's the partially phased in that we subtract away. So again, because the QBI deduction, because the wage and property limits of $50,000 is less than the QBI deduction of $60,000, we take the 20% of QBI, which is $60,000, minus the partially phased in wage and property limits, which is $4,000, we calculated in step 3. So we take $60,000, which is 20% of QBI, minus the $4,000 we just calculated in step 3, gives us $56,000. So that is the QBI deduction. And that is situation number 5. Okay, situation number 6, now we're at or above the threshold plus amount. This is going to be 20% of QBI, but it's limited by the wage and property limits to 100%. Because looking at situation number 5, now we're all the way there, right? So there's no phase in, we're at 100%. So here's situation number 6. And remember, or just like we saw situation 1, 2, and 3, for situation 4, 5, and 6, I kept the QBI number the same. The taxable income is all that changed. So this is very similar to situation number 5, except the taxable income is $470,000, which is much greater than the threshold plus amount. So taxable income $470,000, they're married, filing joint, $300,000 is QBI, and there's it's a qualified trader business, and we have we have W-2 wages allocable to W of $100,000. Okay, and there's no qualified property. So we're going to do 20% of QBI. We're going to take the lesser of 20% of QBI or the wage and property limits. That's how it works. Okay. So it's important to note that the wage and property limits are fully phased in. So the lesser of 20% of QBI or the wage and property limitations. So we always first start with the wage and property limits because that's a greater of rule. So it's going to be Remember, all we have here is W-2 wages. There's no qualified property. So 50% of the W-2 wages is $50,000, or 25% of W-2 wages plus 0 for the qualified property is $25,000. So the W-2 wage, the wage and property limit here is the greater of the two numbers, which is $50,000. So we take the lesser of the $50,000 wage and property limit, or the QBI deduction, which is 20% of 300,000 QBI, which is 60,000. So the deduction equals the lesser of these two, 60 or 50, which is 50. So the QBI deduction is 50,000. So that concludes the 6 situations. So now, looking back at our chart, once we get through situations 1, 2, 4, 5, and 6, note I didn't say situation 3. Why? Situation 3 cannot get the deduction ever. Situation 3 was a specified service trade or business where the taxable income is above the threshold, at or above the threshold plus. So if you're in situation 1 or 2 for a specified service trade or business, or situations 4, 5, and 6 for a qualified trade or business, you take that number you calculated and you get the combined qualified business income amount by adding up all the amounts that you've gone through in this decision chart for each business entity, and you add to that 20% of qualified REIT dividends and 20% of publicly traded partnership income. And then finally, we go back to the taxable income limit, and then if the taxable income limit applies, it limits it. If it doesn't apply, then this number here, the combined qualified business income amount, is what goes on page 2 as the qualified business income deduction on the tax return. So here again is your decision chart. So definitely study this. It definitely helps you. Again, to recap, this is done for each trade or business. We start at the top, own and operate a trade or business. If we have that for a trade or business and not an investment or personal activity, then we continue. If we're not a C corporation, we continue. If we're a C corporation, you just stop. You don't get it. Once you're not considered a C corporation, then you have to ask, are you a specified service trade or business, a qualified trade or business, or the trade or business of being an employee? So there's a red light, yellow light, green light. If we're the red light, we stop. Trade or business of being an employee, you can never get the deduction. If we're a yellow light, we're severely limited. We prefer to be a green light if we could. And I'm going to talk in the next video, which is the planning video. So please watch that, about how try to distinguish yourself between specified service trade or business and qualified trade or business, or how you might be able to disaggregate certain activities in your business that might be viewed as specified service trade or business from qualified trade or business. There's different planning techniques that are out there. So for the yellow light, specified service trade or business, then again, we look at the taxable income, the threshold versus the threshold plus. We look at our situation. Situation 1, 20% of QBI. Situation 3, can't get it. That's at or above the threshold plus for specified service trade or business, cannot get the deduction. If you're situation 2, you're somewhere in the middle and you have to phase out the deduction, because once you get to 100%, you can't get it. But you also have to phase in the wage and property limits, because that's how they apply. They apply based on taxable income numbers. On the qualified trade or business side, which is the green light, if you're in situation number 4, which is at or below the threshold, just like situation number 1, 20% of QBI. If you're in situation 6, which you're at or above the threshold, then it's 20% of QBI, but you're limited to the wage and property limits at the full amounts. If you're in situation number 5, you're in between, it's 20% of QBI, but it's limited by the wage and property limits, but they're phased in, so we subtract the portion away depending on what the wage and property limits are. And again, all those numbers go down to the bottom from situations 1, 2, 4, 5, and 6. And you do this for each trade or business activity. Okay? So each trade or business activity will result in one situation. That's the idea. And then that goes down to this big box on the bottom, and you calculate that for each business entity, and that's when you do the overall taxable income limits, and that's when you add the publicly traded partnership income, the REIT dividends, and then you go to the overall taxable income limits, and that gives you your total amount for the tax return on page 2. All right, so we're almost done. Other considerations. So I'm just going to talk about a few things. What about losses? What if a business entity, again, you do this for each business entity for a year, what if it results in a loss? And what if your total amount at the bottom is a loss number? Well, losses from one business will offset others. So if you go through our flow chart, and let's say you have multiple trades or businesses, and one business comes out, because remember, you're allocating, the QBI is an income concept, but actually it's actually the allocable share of income, deductions, losses, gains, all those things. So it's possible you could have a loss because you could have more deductions than income, okay? That's really important to understand. Well, from one business entity, if it results in a loss and the others result in income, you offset those. You offset those numbers using the 20%, okay, just so you know. Now, if there's an overall loss for combined QBI, then you just don't get a deduction for the year, and it's carried over to the following year that is used to reduce QBI in the combined QBI in the subsequent year. So you have to put it into the mix, just like you do if similar to passive losses. How if you have a passive loss for a year and you can't take it or deduct it, then in the future you'll suspend it and bring it forward to the next year, and it will be used in the analysis as well. So you do use it in analysis. If you have an overall loss for the year, you just get 0 QBI deduction for that year, but that number flows through to the next year, and guess what? It's going to be used to offset any incomes that you have. And it keeps going and going and going and whatnot. What happens when your business activity ends? That's a question. Again, this is a basic discussion for you to look into. So some other items. When I talk about the allocable share of items of W-2, depreciation, or whatnot, we apply, if it's a partnership or LLC, we apply the substantial economic effect the way that we normally allocate the distributive share. Again, I'm not going into the advanced topics, and especially not substantial economic effect and how we do allocations. I do have some videos on that if you would like to learn about that, but we do apply those rules. For S corporations, it's a lot more simple because we just use a more pro rata analysis for those items. But it is an allocable share of those items. For sole proprietorship, I mean, there's only one owner, so you just allocate out, or a single member LLC. AMT. So the provision, Section 199 Cap A, Qualified Business Income Deduction, does state that the AMT is an issue. However, it doesn't really look like the AMT, there's really any way that it can be affected. So really the AMT, practically speaking, is not an issue. As I mentioned, inflation adjustments. And I just want to highlight again that when you're watching this video, I'm talking about the 2018, the baseline numbers, but when you're watching this in the future, these are inflation adjustments. Sunsetting. So when this provision was enacted, it was 2018, tax years 2018 to 2025. Okay, beginning in January 1st, 2018. Beginning when a taxpayer begins tax year in 2018. That's when it starts. So the earliest tax years I can get this are actually 12/31, 2018. Okay, you have to be a calendar year. If you're a fiscal year, then it's going to be rolled over to your 2019 year, just so you know. That's when the first application. But it sunsets after 2025. So 2025 is the last year. Okay, that's at the time it was enacted. When you're watching this video, it could be after that. And just to note, it could still be going, and that's likely the case. Just as you're aware, Congress at the end of the year renews a lot of the provisions that are set to sunset, and that's the same case here. This is a provision that's likely to sunset because remember, going back to our history discussion with the corporate tax, it's really important to understand that we did this for, the main driver of the Tax Cuts and Jobs Act was the corporate tax rate to lower that to a lower rate to be more competitive. And that this provision was put in to help combat with the issue that people will flock towards using C corporations for tax planning. So if we still keep that, it's likely that this provision will get enacted and will stay healthy and keep going into the future. It'll be tied to that lower corporate tax rate. Married filing separately. Okay? So when in the tax law do you ever tell clients to file a married filing separate tax return? Not that often. I mean, there's a few cases you're dealing with, one taxpayer has the government garnish wages or whatnot, maybe back child support, those kind of things. You're dealing with student loans, not earned income tax credit because you can't do married filing separate for earned income tax credit, but those kind of things, right? Those are the big ones, student loans and garnish of wages. This is another going to be a big example because if you're married filing joint and you have a taxpayer that has a lot of W-2 wages, that could raise the taxable income, but then you have another taxpayer has some, small business, qualified business income, and on their own, they would actually get the QBI deduction under the single or the other rules, versus if they're married filing joint, they wouldn't get it because they might be in situation number 4 or situation number 6. Well, especially situation number, not situation 4, situation 3 or situation 6, especially situation 3, that's really the big one. I can definitely see a case where you have a situation 3, you have someone's a service provider, and they're a specified service trader business. If they're on their own, they might be situation 1 or situation 2, but with their spouse, they're definitely situation 3 with their taxable income, so they can't get the deduction, so they file separate so they can get the benefit of the deduction. So I can definitely see cases where married filing separate will be popular by different taxpayers because of this provision. Finally, when this was first enacted, there was actually a part, when you look at that REIT dividend and the publicly traded partnership income, there was actually a part that dealt with adding in a portion for agriculture and horticulture cooperatives income from that. Well, there was actually a change a few months after the tax bill that, remember the old domestic production activity deduction I mentioned? It's basically 9% or a certain percentage of certain activity to help promote certain activities. Well, actually what happened is the agriculture and horticulture cooperatives, they actually became their own provision in Section 199 Cap A little g, subsection G. So Section 199 Cap A subsection G, where the domestic production activities deduction that we used to have actually came back a few months later after it was repealed and applies specifically to that provision. So now they're in their own little area. So for those people out there that deal with farming industries, just be aware of that. All right, so I really hope you enjoyed this video. I highly, highly, highly recommend rewatching this, going back over these things, because it will really help you. And watch the planning video. The planning stuff is really helpful and really interesting as well. And now you've gone through all this, you put in the time to go through the mechanics. Man, really, woo, it's a tough video, right? We've gone through a lot. It's really going to help you understand the planning elements, which is going to make you a more effective tax professional.